Hello, everyone. I'm Kim Carrigan here at Bankers Advisory. Over the last couple of years, the federal government has reshaped lending practices to ensure safer mortgages. The qualified mortgage, or QM, has a number of checks and balances, including the determination as to whether the borrower has the ability to repay. Here to explain is leading author and CEO of Bankers Advisory, DeSimone. Now, Anna, in our last segment, we talked about qualified mortgages, and you said that one of the most important rules is the ability for the borrower to be able to repay. Now, explain exactly what we're talking about there.
It's exactly how it sounds, Kim. The lender needs to prove, and we've used the word memorialize, that they've made a good faith determination that the borrower can afford this loan, not only up front initially for the first few years, but over the course of time.
And how exactly does that work?
The steps and practices that the lender has to follow really hasn't changed much in the past 20 or 30 years. I mean, banks and mortgage lenders for decades have been, looking at a borrower's assets, looking at a borrower's income, ordering property appraisals and credit reports. So, the basic steps really aren't going to change that much. The only problem with the ability to repay is that, not all Americans have a 9-to-5 job that's 100% salaried, stable wages. People change jobs.
Sure.
People get overtime. People get bonuses. People are self-employed. People get income from alimony, child support, and supplemental Social Security income is countable. Retirement income is countable. And so what we need to do is to look at all of the different types of income a person could possibly have, make sure it's documented, and then utilize that income to appropriately qualify the borrower for their loan.
So you've said that they've been sort of following the same rules and guidelines for the last 30 years. There obviously must be something new in this.
The most significant new change that applies to the QM is a 43% maximum debt-to-income ratio. Let me give you an example.
Okay.
A borrower makes $5,000 a month. We're going to take that $5,000, multiply it times 43%, and in that figure, whatever we come up with, we're going to have to apply that to all of the borrower's outstanding debts, the monthly payments of those debts, and the monthly payment of their mortgage payment, which has to include the principal, interest, taxes, insurance, and condo dues.
So 43%, obviously that's roughly half of a person's income. Now that's not so bad if it's going towards your mortgage, right?
No, but the thing we want to remember is that all mortgage lending rules are based on the gross monthly income. So that person who's earning $5,000 a month gross monthly income may only have a take-home income of about maybe $3,500 to $4,000. And it's a universal standard, this debt-to-income ratio, and I do have to say that the 43% that's been established under the QM rule is, I think it's very liberal, because some traditional lending programs have maxed out that ratio, what we call the debt-to-income ratio, as 36, 38%. But 43% is, it's really pretty liberal, and I think it's definitely realistic and doable for both consumers and lenders.
By the way, that's all income coming into the household, is that correct?
That's right. That's all the different sources of income. The key to income is there a history? Is it likely to continue? As it's stable? And so all of those sources of income, they need to be acceptable. I mean, there are certain types of income that would not be acceptable to a lender. But a lender will also often look at a borrower's tax returns. But when those income figures are actually computed by an underwriter, the underwriter has to go through a number of steps sometimes to average out an income over a period of time. And then you take the 43% of that figure.
Like, for example, someone who gets bonuses, you'd have to sort of average that out over a year. So when they're looking into this 43%, we talked about income. Now let's talk about monthly debt. What exactly is that?
Okay, well, the 43% has to include the principal, interest, taxes, and insurance, which we will call the PITI. Lenders will also refer to this as the housing payment. Now, the rest of that scenario has to cover the monthly payment that would be applied to all of the outstanding credit card balances, automobile loans, installment loans, child support, separate maintenance, alimony, any debt that would exceed another year. We're probably just looking at 12 months in the future to incorporate that into that 43% debt ratio.
So when you talk about credit card debt, now that's got to be difficult to really sort of pin down, is it not?
There are all kinds of incentives for people to pay their credit cards off, on a monthly basis. So what a lender is going to do when a borrower applies for a loan is they're going to pull the credit report on that borrower, and they're going to look to see what the existing balances are. And whether or not the borrower pays $150 a month and they only need to pay $15, or maybe they pay the whole thing off, it doesn't matter. What the lender does is they take 5% of that outstanding balance. So if the consumer owes $5,000 in credit cards, the underwriter is going to automatically write in $250 and incorporate that into their monthly debt.
Okay, so let's walk through these numbers one more time.
Okay, well, we'll take someone that maybe is a two-income family.
Okay.
The total household earnings gross is $10,000 a month. So it's easy to think of the math as $4,300 a month. Let's say we have a mortgage payment that's $2,000. All right, so we're going to subtract the $2,000 from the $4,300, and that leaves the lender $2,300 to pay all of their other debts. That might seem like it's a lot of money, but let's look at how quickly we can go through $2,300.
Right.
2 car payments at $300 or $400 each. We're going to drop from $2,300 down to $1,700. And depending on how much someone owes in their credit cards, if they have student loans, if they're paying any child support or outside maintenance, all of this has to be covered in that remaining balance. And so it seems like there's a lot of flexibility there for someone who's earning $120,000 a year, but unfortunately that may not be the average income for a lot of home buyers today.
So Anna, what do they do about loans that you have outstanding that maybe will end soon? For example, let's say a student loan, and maybe you only have a year and a half left on that student loan.
What a lender does is they look to see what loans are going to remain or what monthly payments are going to remain for more than 12 months. What the lender might say to the borrower is, well, you've only got 16 car payments left. But if you make 6 car payments and you've only got 10 payments left, we're going to be able to squeeze you into a better program. We really need to have the consumer come to their lender's office with all of their paperwork in their hand, and so when the lender says, well, how many more payments do you have on your loan? And the consumer says, I have no clue.
Right.
That's the difference between getting the mortgage and not getting the mortgage.
Yeah, if you can come there prepared, I'm sure that makes all the difference in the world, and maybe with a little extra money to make some of those extra payments and get you into another position, which would be better.
Absolutely right.
So Anna, you've said that when a borrower comes into the lender's office, they have to be prepared to answer a number of questions. So give me a sense of what some of those questions are and how that helps in the long run.
Well, the borrower has to be organized. They need to have copies of their pay stubs. They need to have copies of their W-2s. They need to be able to present copies of their taxes. So if a homeowner is looking to refinance, they've already been through the process once before, so they know what kind of questions are going to be asked.
Right.
But for the first-time home buyer, it's even more challenging because they're not exactly quite sure what to do. I think the best thing the consumer can do is to kind of think the way the government is thinking and have all of this information available when you go to visit the lender.
Now let me ask you a quick question about the employment. You have to be able to verify your employment, yes, and how long you've been there. So don't go there and fib, because they will ultimately check that out.
Well, the thing about the ability to pay is, it's all based on income, and so what the borrower needs to do is to, tell the lender, how many years they've been making a certain salary at what job. So lenders will usually go back 2 years, but if a person changes their industry, if they go from being a computer programmer to a salesperson, and they'll say, well, last year I made $46,000 a year as a computer programmer, and now I'm making $60,000 a year. And the consumer is going to think, hey, if I'm making $14,000 more, I should be able to borrow more, but not so fast, because the lender is going to say, out of that $60,000, is there any bonus or commission in there? And the consumer's saying, well, yeah, now that you mentioned it, I have a $30,000 base and I have $20,000 in commissions. Do you follow me?
Absolutely.
And so the first thing that the lender is going to say is, well, can you prove that you've had a history of this? We have to remember that the key word is documentation.
Documentation, right.
The history.
Sure.
And no one goes out and buys a house and then gets to the mortgage lender and goes through all of these steps within 2 or 3 days. They really need to start planning, just like they're going around driving and looking at neighborhoods, talking to lenders to see what their affordability is.
Right.
They need to spend a few weeks at home on the kitchen table and getting all of that paperwork and tax returns and bills out and saying, all right, what do we anticipate the lender is going to ask?
So Anna, let's talk about the borrower who comes in. They have a very large down payment. They're debt-free, but their income is low, so they may not fall in that 43%. What does the lender do then?
The lender likes that kind of borrower. Any borrower that's debt-free and has the whole down payment saved for their new home is a low-risk borrower. That's a good borrower, and the lender is earnestly going to want to work with that borrower. I can't say 100% for sure that the loan may ultimately result in a QM loan, but I will say this, there are so many mortgage programs out there that will consider something called a compensating factor, and that borrower would have no trouble getting a low-risk mortgage for themselves. That would be very affordable for them and a safe loan.
So 43%, not hard and fast. There can be a bit of flexibility
I think
there.
so. I think we're going to see a little bit of flexibility there, especially for borrowers like the one that you suggested.
So Anna, it sounds like one of the keys when it comes to the ability to pay is that the borrower has to prove their income and they have to prove that they can actually pay for the loan.
That's right. That's right. And we're going to be talking a little bit more about how the lender and the lender's staff and underwriters take all those different types of income and average it out so that they come up with the correct figure and the borrower qualifies within that 43% rule.
So Anna, as we wrap this up, give me some key points that the borrower needs to keep in mind as they go to get a loan and their ability to pay.
First one is be prepared. Go to the lender with a lot of detail on the history of your debts and your income, current pay stubs and documentation, and very detailed information on your current debts. 3 important things.
Be organized when you get there.
Absolutely.
And be patient.
Yes.